All right, today we're diving into one of the most fundamental numbers in all of business. It's a single figure that can tell you if a company is boldly building an empire or, just walking a really dangerous financial tightrope. We're talking about gearing. So let's just get right to the heart of it with the one question every single business owner, investor, and manager has to wrestle with. How much debt is too much? I mean, it's such a critical balancing act, right? Because debt can be this amazing tool for growth, but there's always that risk. A great way to think about this is like taking out a mortgage on your own house. That loan, it lets you buy an asset you probably couldn't afford up front, but you're on the hook for those payments every single month, no matter what happens. Well, businesses face that exact same dilemma, just on a much bigger scale. They need cash to grow, but borrowing it creates these heavy obligations that can get pretty dangerous if things go south. So, how do we actually measure this risk? I mean, how do you put a number on that financial tightrope we talked about? Well, thankfully, there's a specific tool for that, and it's called the gearing ratio. Okay, so what is it exactly? Well, to put it simply, the gearing ratio tells you what percentage of a company's money comes from borrowing versus how much comes from the owners or shareholders themselves. Think of it like a quick snapshot showing you just how much a company is relying on debt to operate. And here's the formula. Now, don't worry, it looks simple because it really is. All we're doing is taking the company's long-term debts, and in accountant speak, that's non-current liabilities, and we divide that by the total long-term money in the business, which is called capital employed. So let's quickly break down what that capital employed part actually means. Right, so capital employed. It sounds a little complex, but I promise it's not. It's just two things added together: the money the company borrowed for the long haul, plus all the money invested by its owners and shareholders, what we call total equity. So really, the gearing ratio is just asking, of this whole pie of money that the company is using, how big is the slice that's made of debt? Okay, so now we've got the formula, but a number by itself doesn't really mean anything. So let's get into how to actually read the result and figure out what it's telling us about a company's risk. This is a great way to think about it, like a riskometer for a company. Down at the low end, anything under 25%, that's considered low-geared, super safe. Then you have the normal range, between 25 and 50%. That's a totally manageable level of debt for most companies. But once you creep over that 50% mark, well, that's when the needle starts tipping into the red zone. Yeah, that 50% mark is really the line in the sand for most analysts. When a company's ratio is above 50%, it means more than half of its funding is coming from lenders, not its owners. And that just fundamentally changes the game. It makes the company way more vulnerable, and it's a big flashing signal that says, hey, you need to look a lot closer at what's going on here. So why all the fuss about high gearing? Well, it's because it is a classic double-edged sword. It can offer incredible rewards, but it comes with some pretty serious dangers. And this quote just nails it, doesn't it? When you use it wisely, debt can help you build an empire. But if you manage it poorly or just get unlucky, it can be the one thing that brings the whole house of cards crashing down. So let's break down both sides of that blade, starting with the upside, the opportunity. See, with borrowed cash, a company can expand way faster, jump into new markets, and hopefully generate massive profits. That's great for shareholders, right? Higher returns. But then there's the other side, the danger. If interest rates spike, suddenly their loan payments get way more expensive. If a recession hits and sales dry up, too bad. They still have to make those payments. It is absolutely a high-stakes game. And look, this isn't just some abstract number that accountants worry about. The gearing ratio has a huge, real-world impact on pretty much everyone involved with a company. So let's take a look at it from a few different perspectives. Okay, let's say you're a shareholder. High gearing puts you in a tricky position. On one hand, it could supercharge your returns if the company's big bets pay off. But on the other hand, it also seriously increases the risk of the whole business going under and you losing everything you invested. And don't forget, the more debt they have, the more of the company's profits go to paying the bank's interest, not to you in the form of dividends. Now, if you're a manager, debt is basically the fuel for your ambition. It's what lets you chase those big, bold growth plans. But with that power comes an incredible amount of pressure. They're the ones responsible for making sure those loan payments get made every single month without fail. Honestly, their job, their reputation, it all rests on how well they can handle that tightrope walk. And then you've got the lenders, the banks. What do they think? Well, their view is actually way simpler. They just want their money back with interest. So for them, a low gearing ratio is a giant green flag. It tells them the company is stable, it's a safe bet. But a highly geared company, that's a huge red flag. It screams risky loan, and they're either going to charge you way higher interest rates for that risk, or more likely, they're just going to say, no thanks. So what happens if a company looks at its riskometer and sees it's way too high in the red? What can they actually do about it? Well, the good news is gearing isn't set in stone. It's something that can be and absolutely should be actively managed. A company actually has a few different levers it can pull to fix this. The most obvious one, just repay some of their long-term loans. That shrinks the debt part of the formula. Or they can issue new shares of stock. That pumps up the equity side, which makes the debt look smaller by comparison. Another smart move is to just hold on to more of their profits instead of paying them all out as dividends. All of these are ways to get that ratio back down into a much healthier, safer range. And this really brings us to the most crucial point of all. There's no such thing as one perfect gearing ratio. It just doesn't exist. A fast-growing tech startup might actually need high gearing to fund its expansion, but a super stable, predictable utility company, they'd want a really low ratio. It is all about context. It's about finding that strategic balance between ambition and safety and making sure your finances match your industry and your goals. So that leaves us with one final question for you to think about. The next time you hear about a company taking on a ton of debt, you'll know what's really at stake. So ask yourself, is this a sign of bold ambition, or is it a warning sign of just too much risk? The cool thing is, now you have the tool to help you figure that out.